As always, the views expressed during today's webinar are those of the speakers, not of Strafford, the speaker's firms, or clients, and are not intended to provide legal advice or counsel. We have gathered an authoritative panel to review appropriate terms and enforcement of revenue sharing agreements, applicable due diligence in avoiding prohibited transaction rules, and best practices for dealing with excess payments. Our panel today includes Elizabeth Dyer from Mayor Brown in Chicago. She's joined today by Lawrence N. Vignola, Managing Principal at Stable 2 Financial in Cincinnati. And rounding out our panel is Marcia S. Wagner, Managing Director at Wagner Law Group in Boston. So Elizabeth, when you're ready, we'll get started.
Okay, great. So as a preliminary matter, we wanted to give you a quick overview of what the presentation today will cover and who will be covering kind of what areas. So first, I'm going to discuss revenue sharing arrangements and plan asset status. Then I'm going to turn it over to Marcia Wagner, who's going to discuss fiduciary due diligence relating to revenue sharing arrangements, including considerations arising with respect to Section 408B2 of ERISA and reporting requirements. And then Marcia's going to turn it over to Larry Vignola, who's going to discuss processes for conducting due diligence relating to revenue sharing arrangements, best practices for monitoring revenue sharing arrangements, and alternative pricing models. And then at the end, we'll have some time to field some questions. So turning to my discussion of revenue sharing arrangements and plan asset status. So I'm going to first give you a brief overview of revenue sharing arrangements and then discuss the question of when revenue sharing payments constitute plan assets. And then lastly, I'll run through some considerations that are applicable when revenue sharing payments constitute plan assets. So it's helpful first to very quickly run through what is meant by the term revenue sharing. So this term generally refers to payments that plan investment options, most commonly mutual funds or advisors to mutual funds, make to plan trustees, record keepers, and other platform providers. So revenue sharing payments can take a wide variety of different forms. They can come in the form of 12b1 fees, which are distribution or servicing fees and are generally paid by mutual funds to broker-dealers as compensation for selling and marketing the mutual funds shares. Revenue sharing payments can take the form of sub-transfer agency fees or other shareholder servicing fees, and these fees are generally paid by mutual funds to record keepers as compensation for maintaining the records of the mutual fund shareholders and for other operational services. And then revenue sharing payments can also come up when a manager of a mutual fund pays a portion of its management fee to a third party. For example, a manager may take a portion of its fee and pass it along as a commission to a broker in connection with a sale. So revenue sharing arrangements can be structured in a wide variety of ways, and in the earlier days and for smaller, more retail plans nowadays, plan service providers typically retain all revenue sharing payments. However, as revenue sharing payments have come under increased attention, industry practices are trending towards tracking these payments and using them for the benefit of plans. So it's more common nowadays, and especially for larger plans, to see arrangements where these amounts are credited to the plan in one way or another. So the type of arrangement that's in place will have implications for whether the revenue sharing payments constitute plan assets and are subject to ERISA's fiduciary and prohibited transaction provisions. In terms of the types of arrangements that are out there, Marcia and Larry will cover this in greater detail later in the presentation, but just to give you a really high-level overview, some arrangements provide that all revenue sharing payments are retained by the plan service provider as compensation. Others provide that all revenue sharing payments are retained by the plan service provider, but that the plan may receive credits. Others provide that the plan is entitled to receive revenue sharing payments that exceed the amount payable for record keeping or other specified services. And then lastly, some arrangements provide that the plan is entitled to receive all of the revenue sharing payments. So last year, the Department of Labor released guidance in the form of Advisory Opinion 2013-03A, which explored the question whether and when revenue sharing payments constitute plan assets under ERISA. So first I'm going to run through the factual background for the advisory opinion, and then I'll talk about the Department of Labor's analysis and conclusions. So the underlying facts in the advisory opinion are as follows. Principal Life Insurance Company provides record-keeping and related administrative services to defined contribution plans and also makes available to such plans investment options. Included among these investment options are its own separate accounts and both affiliated and unaffiliated mutual funds. Principal receives revenue sharing payments from these investment options and agrees to either maintain a bookkeeping record of revenue sharing payments received in connection with the plan's investment options, or to deposit the revenue sharing payments directly into a plan account periodically or on a specified date. So where Principal maintains a bookkeeping record, which is the first alternative I just mentioned, of the payments received in connection with the plan's investment options, the following facts are also applicable. So the record reflects the credits calculated by reference to the estimated revenue sharing payments, and then in accordance with the agreement between Principal and the plan client and at the direction of the plan's fiduciaries, the credits may be used to pay certain plan expenses, which include payments for services of accountants, consultants, actuaries, and attorneys. The credits are held as general assets of Principal, and Principal doesn't establish a separate bank or custodial account to hold the credits. That's an important one. And the agreement between Principal and its plan clients does not require Principal to segregate the credits for the benefit of any of the plans. And then lastly, Principal makes no representations that the credits will be set aside for the benefit of the plan clients or that the credits represent a separate fund for the payment of benefits or expenses under the plan. So now that I've run through the factual background, we can move on to the Department of Labor's analysis. So the Department of Labor stated that plan assets are generally determined by applying ordinary notions of property rights to the specific arrangements at hand, and that the assets of the plan will include any property, both tangible or intangible, in which the plan has a beneficial interest. So in applying these ordinary notions of property rights to the specific arrangements, the Department of Labor noted that you have to consider the contract or other legal instrument involving the plan and the actions and representations and communicated intent of the parties involved. So the mere segregation of a service provider's funds to facilitate the administration of a contract with the plan would not in and of itself create a beneficial interest in those assets on behalf of the plan. And you'd have to look at all of the underlying facts and contractual arrangements in place to come up with a conclusion. So applying all of these principles to the facts at hand, the Department of Labor concluded that revenue sharing payments recorded in bookkeeping accounts are not the assets of the client plans before the plans actually receive these payments. However, the Department of Labor emphasized that a plan's assets can include any type of property, tangible or intangible, and that a plan's contractual right to receive revenue sharing payments, as agreed to with Principal, or to have these payments applied towards plan expenses would constitute an asset of the plan. Accordingly, because a plan's contractual right to receive revenue sharing payments constitutes a plan asset, a plan's claim against Principal for failure to pay these amounts as required would also constitute an asset of the plan. So it's important to note that whether or not revenue sharing payments constitute plan assets, the arrangement between Principal and its plan clients are subject to the fiduciary and prohibited transaction provisions of ERISA. So although this advisory opinion gives greater flexibility because it clarifies that revenue sharing payments kept as general assets of the record keeper are not plan assets, plan fiduciaries are not totally relieved of their duties to act prudently and in the best interest of the plan when dealing with revenue sharing arrangements. Accordingly, plan fiduciaries will need to act prudently when negotiating and monitoring these arrangements. And in the same vein, we'll need to consider the revenue sharing payments as part of the overall compensation paid to the record keeper when determining the reasonableness of the compensation. And in terms of prohibited transaction concerns, as a service provider to the plan, Principal would be a party in interest with respect to the plan, and the furnishing of goods and services between a plan and a party in interest will give rise to a prohibited transaction unless covered by an exemption, such as Section 408B2 of ERISA, which Marcia will get into in greater detail next. And then, in addition, when performing basic record-keeping services and acting as directed by the plan fiduciaries, plan service providers are generally not acting in a fiduciary capacity. However, if the plan service provider is acting as a fiduciary, for example, by advising participants with respect to investment selections or by managing a custom portfolio offered as an investment option under the plan fiduciaries still have to consider whether the retention of revenue sharing payments by these service providers will trigger prohibited transaction concerns. So, moving on, if a revenue sharing payment is a plan asset, there are certain additional considerations that will come into play. For example, how can revenue sharing amounts received by the plan be used? So the revenue sharing payments could be credited to an unallocated plan account or used to pay expenses that are permissible under ERISA, with the balance then being allocated to participant accounts. Or the payments could be credited directly to participant accounts. But in any case, plan fiduciaries must act prudently, solely in the interest of participants and in accordance with the plan documents. When making a decision with respect to allocation, there are numerous considerations that come into play. So in Field Assistance Bulletin 2003-3, which actually relates to the allocation of plan expenses, the Department of Labor stated that if the method of allocation is not set forth in the plan documents, at a minimum, prudence would require weighing the competing interests of various classes of participants and the effects of allocation methods on such interests. And so plan fiduciaries will need to consider whether to allocate the revenue sharing amounts pro rata or per capita, and whether to take into account whether a participant is invested in the fund that generated the credit. Plan fiduciaries will also need to consider the timing of making allocations and the accumulation of revenue sharing amounts under the plan. IRS Revenue Ruling 80-155 requires unallocated assets in the plan to be allocated by the end of the plan year in which they arise. So unallocated revenue sharing amounts held in the plan will generally need to be allocated annually. Revenue Ruling 80-155 relates to allocation of assets held in the plan, and the Department of Labor's guidance tells us that revenue sharing amounts held as general assets of the record keeper would not be considered plan assets. Accordingly, plans may have more flexibility with respect to the one-year allocation rule in these cases, but in any case, plan fiduciaries need to be careful that these amounts are allocated to the plan prudently, and the terms of the contracts in place will be very important in these situations and should be carefully drafted and negotiated to flesh out these types of issues. So now I'm going to turn it over to Marcia Wagner, who will discuss fiduciary due diligence relating to revenue sharing arrangements.
Very good. Next slide, please. First of all, good morning, good afternoon, depending where you are in the country. First off, I would like to make extremely clear that revenue sharing as a matter of principle is clearly permitted under ERISA, but as a matter of practice, revenue sharing arrangements can potentially make it more challenging for plan fiduciaries to satisfy their duties to plan participants, beneficiaries, and alternate payees. That's why it's so important for plan sponsors and other fiduciaries to perform due diligence on any plan and record-keeping arrangement. There's a general duty under ERISA that requires plan fiduciaries to evaluate the reasonableness of a service provider's compensation when paid from plan assets. When a record-keeping platform receives a direct fee, as well as revenue sharing through the plan's investments, the plan fiduciary must consider the record keeper's total comp, including any revenue sharing payments. To satisfy this fiduciary duty, plan sponsors need to identify the amount of revenue sharing that is being retained by the record keeper. If certain revenue is being recaptured or redirected away from the record keeper, these amounts must also be identified and tracked. There are many permutations and variations on how record keepers can handle revenue sharing. We cannot, because of time, discuss all of them, but I will talk about 5 common revenue sharing arrangements. This is what I refer to as traditional pricing, revenue sharing offset, fee capture accounts, which come in 2 forms, bookkeeping spending accounts and ERISA budget accounts, and of course, participant level revenue equalization. Next slide, please. Capture accounts are a fairly recent innovation, which are arrangements whereby the record-keeping platform actually returns all or a portion of the revenue sharing that it receives. I just want to briefly mention the traditional pricing model. As a historical matter, this was the customary pricing model embraced by plan administrators, and many record keepers, especially in the smaller marketplace, still use it today. With traditional pricing, the record keeper keeps both the direct fee that it invoices to the plan sponsor, as well as the revenue sharing payments that it receives from the plan's investment funds. As a result of the 408B2 fee disclosure rules, record keepers must now provide an upfront fee notice that describes its direct fee as well as any indirect compensation or revenue sharing. If you do not have a fee recapture account or any offset for revenue sharing, it is critical for the plan sponsor to understand and to quantify the amount of revenue sharing that is being retained by the record keeper. Again, there is nothing illegal about revenue sharing, but in a traditional pricing arrangement, the plan sponsor must perform its fiduciary due diligence and evaluate the record keeper's total compensation, including the amount of revenue sharing received. This due diligence must be performed on an ongoing basis, especially since the amount of revenue sharing that may be earned by a record keeper can vary considerably from year to year, depending on the investments selected by the plan, the participants, and their performance. Next slide, please. Revenue sharing offset. Okay? After the traditional pricing model was introduced, record keepers began to offer an alternative pricing solution in recognition of the fact that plan sponsors want and need greater control and transparency when it came to fees and compensation. Record keepers began to offer revenue sharing offset arrangements. These types of arrangements are sometimes referred to as net pricing, but the idea is the same. The record keeper will agree to provide its services for a stated gross fee, and any revenue sharing received will be used to offset the amount that is due. And so, the plan client only needs to pay the net fee that is due to the record keeper. This net pricing approach makes it much easier for the plan sponsor to perform due diligence. The record keeper does not derive any additional economic benefit from the revenue sharing that it receives. Therefore, when evaluating the reasonableness of the record keeper's total compensation, the plan fiduciary can simply focus on the record keeper's stated gross fee. Of course, it must also confirm that the record keeper is fully offsetting its gross fee by the amount of revenue sharing that it receives. Under the current 408B2 fee disclosure rules, a record keeper is generally obligated to disclose all of the indirect compensation that it receives, even if it is used to offset the plan client's direct fee. And these disclosures can help plan sponsors confirm that the revenue sharing offset is being calculated correctly. Next slide, please. Fee recapture accounts go one step beyond revenue sharing offsets, which begs the question, if a record keeper is offsetting its direct fee by the full amount of the revenue sharing that it receives, why does anyone need a fee recapture account? To answer this question, it is helpful to run through an illustration. Let's say that we have a 401k plan with $2.5 million in total assets. Let's also say that the plan's record keeper offers a revenue sharing offset. The record keeper charges a gross fee of $7,500 for its services. However, the revenue sharing it receives averages out to 30 basis points from the plan's investments. 0.3% of $2.5 million is $7,500 of revenue sharing, which covers the gross fee. Therefore, as a result of the offset, there is no hard dollar fee for the plan client. But now, let's further assume that assets go from $2.5 million to $3 million, and the record keeper's gross fee remains the same. The record keeper is now earning 0.3% of $3 million, or $9,000, through revenue sharing. Even though there is an offset, there is no way to reduce the record keeper's hard dollar fee below zero. Should the record keeper be allowed to retain the extra $1,500 in excess of the $7.5K gross fee? If the $9,000 compensation would be unreasonable in light of the services proffered, it would be a breach of the plan sponsor's fiduciary duty to continue this arrangement with the record keeper. Fortunately, fee recapture accounts can and do solve this fiduciary dilemma. Next slide, please. Fee recapture accounts are a way for plans to capture any excess revenue taken from investments that is above and beyond what is needed by the record keeper to administer the plan. There are two types of fee recapture accounts: those that are bookkeeping accounts and those that are actual plan accounts. In the case of a bookkeeping spending account, the record keeper typically credits any revenue sharing that is in excess of its stated fee into an additional account that is maintained on its books. This kind of bookkeeping account may be called different names, such as a plan expense reimbursement arrangement or PERA. Going back to our hypothetical example, if the record keeper receives $9,000 in revenue sharing on behalf of a plan client, but his stated fee is only $7,500, the $1,500 excess could be credited to a bookkeeping spending account. This credit may then be utilized as directed by the plan sponsor to pay the plan's other expenses, including the fees payable to other service providers. For example, the plan sponsor could direct the record keeper to pay $1,500 to a local third-party administrator for its TPA services. Typically, credited amounts are not set aside by the record keeper, and no amount is held in escrow or trust for the benefit of the plan. This means that the bookkeeping spending account is really just an unsecured promise to pay $1,500. If the record keeper were to become insolvent, the plan would be treated as any other general unsecured creditor of the record keeper. It should be noted that some, but not all, bookkeeping spending accounts may give you the flexibility to allocate the recaptured revenue to participant accounts. Next slide, please. As I mentioned, a fee recapture account can also be set up as an actual plan account. These accounts may be referred to as ERISA accounts or ERISA budget accounts. When amounts are credited to an ERISA budget account, actual funds are transferred into a separate account established within the plan trust. In the case of a bookkeeping spending account, only the excess revenue sharing above the record keeper's fee is credited. However, in the case of an ERISA budget account, typically all revenue sharing payments, and not just the excess, are deposited into the account. Of course, as I mentioned earlier, there are lots of variations on these arrangements, and a plan client could enter into an arrangement where the record keeper only deposits the excess revenue sharing into the ERISA account. At any rate, once deposited, amounts held in the ERISA budget account may be used to pay the record keeper's own service fees or the fees of other unrelated service providers. At the end of the plan year, any unused amount in the ERISA budget account must be allocated to plan participants. Because the ERISA budget account is an actual plan account, the IRS rule prohibiting unallocated accounts under Rev Rule 80-155 would clearly come into play. This IRS requirement only applies to ERISA budget accounts and not bookkeeping spending accounts. Next slide, please. With the almost miraculous advancements in technology, record keepers are now able to implement fee recapture arrangements that can recapture revenue on a participant level. Sometimes these arrangements are referred to as fund revenue equalization, since they address the fact that different investment funds within a plan will pay different levels of rev share. This means that participants who invest in those funds with the highest levels of revenue sharing are effectively bearing a larger portion of the plan's administrative fees, since these revenue sharing payments are being used to subsidize these services. For example, let's say that a plan offers both equity funds and bond funds to its participants. Let us further assume that the plan's investment funds pay revenue sharing amounts that average out to 20 basis points, which is just enough to cover the record keeper's fee or required revenue of 20 basis points. However, the funds pay varying revenue sharing amounts. The equity bonds pay 30 bips in revenue sharing, and the bond funds pay only 10 bips. In this scenario, participants who invest in equity funds would effectively be cross-subsidizing the record-keeping costs of the participants who are investing in bond funds. Participant-level revenue equalization can remedy this subsidy problem by adjusting each participant's accounts with a credit or a debit so that each participant shoulders his or her fair share of record-keeping fee. Specifically, the accounts of participants with investments generating excess revenue would receive credits, and the accounts of other participants would be debited for the amount necessary to ensure the record keeper receives its required revenue. Next slide, please. In terms of fiduciary due diligence, the plan sponsor should have a clear understanding of what type of revenue sharing arrangement is being utilized by the record keeper. Thus, the service agreement with the record keeper should clearly indicate whether traditional pricing, a revenue sharing offset, or some kind of fee recapture will apply. ERISA also requires the service agreement to satisfy the requirements of a reasonable contract or arrangement under ERISA Section 408B2. One critical element is that the 408B2 fee disclosures must be provided reasonably in advance of entering into an agreement with the record keeper as a formal matter. This disclosure obligation is imposed on the record keeper. However, plan sponsors have a corresponding duty to understand and evaluate the total compensation payable to the record keeper, meaning that they need to understand how revenue sharing will be handled under an offset or fee recapture arrangement. So if the disclosures or contract are unclear on the treatment of revenue sharing, it is the plan sponsor's duty to follow up with the record keeper and request additional information. Another requirement for a reasonable contract or arrangement is that the plan sponsor must have the ability to terminate the service agreement on short notice and without penalty. For example, if a service agreement can only be terminated within, say, a 6-month period of time, that would be a problem under these requirements. The bottom line is that a fee recapture arrangement can help you meet your fiduciary duties, but it is important to make sure you are doing all the necessary fiduciary due diligence. Next slide, please. Now we're going to turn to suggested best practices. Due to the unpredictability of revenue sharing payments for care, if at all possible, we recommend highly working with record keepers that provide for some kind of fee recapture, whether it be through a bookkeeping account, an ERISA budget account, or participant-level fee equalization. If you use the fee recapture account to avoid plan asset, bookkeeping spending account is the way to go. Next slide, please. Under DOL, Advisory opinion 213-3 amounts accredited to your typical or prototypical bookkeeping spending account. The credited amounts generally will not be deemed to be plan assets. A bookkeeping spending account won't be subject to a trust and custody rules, and you won't have to allocate unused credits at the end of the year. The flip side of being free from these restrictions is that the plan's right to direct the use of the credited amounts is governed completely by contract, so you will need to be especially careful in reviewing the contractual provisions that govern the plan's bookkeeping account. There are two areas in particular you need to focus on. First, if there are any unused credits when the record keeper services are terminated, what happens to them? Second, would the plan have the flexibility to have amounts credited to the bookkeeping account paid to the plan and allocated to participants? In many cases, the contract will be silent on what happens to the unused credits in the event of termination. Of course, if the plan has the flexibility to have the unused credits allocated to participant accounts, the termination issue is somewhat mitigated. As you can see, the contractual terms are especially important if you have a bookkeeping spending account, and ERISA counsel should be consulted to review the relevant provisions. Next slide, please. If you are okay with plan asset status, then you may wish to consider an ERISA budget account. With these types of plan accounts, it is especially important to review the plan document. The plan's provisions customarily govern how amounts are to be allocated to participant accounts. Because an ERISA budget account is required to allocate any unused funds to participants each year, in my opinion, the plan document should state how these amounts will be allocated. In addition, amounts deposited in such accounts will need to be invested in some fashion. The plan document should be reviewed to ensure the plan's trustee or other fiduciary will be directed or have the ability to invest in cash or other appropriate short-term investment. ERISA budget accounts are similar to forfeiture accounts and plans in that both may be used to pay plan expenses or for allocations to participants. However, there's one important distinction. Forfeitures may be used to offset required employer contributions, but amounts held in an ERISA budget account may not be. They're more viewed as earnings from the plan's investment funds. Therefore, this revenue should not be used to reduce an employer's mandated matching contribution or other employer contribution. Thus, the plan document should not improperly treat ERISA budget accounts as if they were mere forfeiture accounts. Unfortunately, many plan documents are silent on ERISA budget accounts, and ERISA counsel should be consulted to determine if any plan amendments are necessary. Basically, for your ERISA nerds out there, as I am, this is a Section 406B self-dealing concern. If the employer is effectively on the hook to make a 50% match and then uses plan money to reduce its liability, it's a gray area under 406B, and it is a risk. Next slide, please. As a best practice, plan fiduciaries should investigate and estimate the amount of revenue-sharing payments that are made on a quarterly basis. Computing these quarterly estimates is an easy way for plan fiduciaries to confirm that the net fee payable to the record keeper is being calculated correctly in the case of a revenue-sharing offset or bookkeeping spending account. If the estimated revenue sharing as determined by the plan sponsor is greater than the amount that's being deducted from the record keeper's gross fee, the plan sponsor really needs to ask the record keeper for a reconciliation. In many instances, the record keeper's quarterly installments for its net fee will be based on its own estimate of the revenue sharing that's expected from the plan's investments. Thus, An annual reconciliation will need to be made by the record keeper, and corresponding adjustments will need to be made to the record keeper's net fee on an annual basis. This type of annual reconciliation is generally not required for ERISA budget accounts, since all revenue sharing is typically deposited into the account and the record keeper's fee is debited from such account only at the plan sponsor's direction. Similarly, annual reconciliations are not required in the case of participant-level revenue equalization, since exact credits and debits are computed and made to the individual participant accounts on an ongoing basis, for example, monthly. Next slide, please. Plans are subject to ERISA's reporting requirements, which generally require plans to file annual information returns with the DOL on the Form 5500 series. Amounts credited to a bookkeeping spending account are not plan assets, but amounts deposited to ERISA budget accounts or through participant-level revenue equalization are plan assets and would need to be reflected in plans' financials. For large plans with 100 participants or more, plans must separately report the direct and indirect compensation payable to its service providers on Schedule C. If the funds held in an ERISA budget account are used to pay for the services of a plan's record keeper or another provider, since these funds are clearly plan assets, all payments to the providers should be viewed as direct compensation paid from the plan itself. If the amount credited by the record keeper under its bookkeeping spending account are used to pay another provider, like a local TPA, the payment from the record keeper to the other provider should be viewed as indirect compensation for reporting purposes. With participant-level revenue equalization, the revenue sharing payments used to pay the record keeper should be viewed as indirect compensation, since they are sourced from the plan's investments rather than the plan itself. The distinction between direct and indirect compensation for Schedule C purposes is also important for 408B2 disclosure purposes. So providers should modify their 408B2 fee disclosures as necessary when receiving compensation through an ERISA budget account or bookkeeping spending account for sure. Next slide, please. Before any amounts credited or deposited to a fee recapture account are utilized, you should pay close attention to the ERISA restrictions that limit a plan's ability to pay expenses. These restrictions apply to both ERISA budget accounts as well as bookkeeping spending accounts. ERISA budget accounts, by their nature, hold plan assets and are subject to these restrictions. With respect to bookkeeping spending accounts, although the recaptured revenue is not considered to constitute a plan asset, the plan's contractual right to this revenue is deemed to be a plan asset under Advisory Opinion 2013-03 Cap A. This means that recaptured revenue under both types of accounts must be used for the benefit of participants, beneficiaries, and alternate payees, and not the plan sponsor. Specifically, in accordance with the requirements of ERISA, the recaptured revenue may only be used to pay reasonable and necessary expenses of the plan. Since funds may only be used to pay necessary expenses, the recaptured revenue can only be used to pay the plan's administrative expenses and not settlor function expenses. Settlor expenses would include the cost of change in the plan design or for other costs relating to the employer's decision to establish or terminate the plan. Recaptured revenue can never be used to pay for non-plan expenses. Since funds may only be used to pay reasonable expenses, plan fiduciaries should make sure that the total compensation payable to the provider is reasonable in light of the services provided before authorizing the use of recaptured revenue to pay for the provider's fees. Next slide, please. In the case of bookkeeping spending accounts, if your contract with a record keeper permits it, you can use any excess revenue to fund an allocation to plan participants. Similarly, with regard to ERISA budget accounts, the amounts held in these accounts need to be allocated to participants if they are not used and exhausted by the end of the plan year. If you want to allocate the recaptured revenue to participants, you will need to decide on an allocation method. There is little guidance in this area, but it would be prudent for plan fiduciaries to have a documented, rational basis for their allocation method. For example, if revenue sharing is credited to the fee recapture account based on an asset-based formula, it may be appropriate to allocate such funds on a pro rata basis based on the size of a participant's account, rather than allocating a flat dollar amount per capita. If you want to avoid this issue completely, you may wish to consider participant-level revenue equalization, which automatically provides for individualized credits and debits for each participant based on his or her specific investment holdings and revenue generated therefrom. I just want to add that having high levels of recaptured revenue is not necessarily a good thing, even if the additional funds are being allocated to the plan's participants. It could mean that the plan is in an inappropriate share class, and you should investigate and see if a cheaper, a less expensive, a more effective share class is available for the plan's investment funds. Although the level of revenue sharing might be reduced, a cheaper share class may be a significantly better deal for your participants because of the lower fund expense ratio. And with that, it is my pleasure to turn this over to Larry.
Thank you very much, Marcia. And I think Liz and Marcia have both done an excellent job discussing what revenue sharing is and how it can be used by a plan sponsor. My goal is to try to shed some light on how a plan sponsor can create a thoughtful due diligence process, as well as to build on some of the comments that Marcia in particular made regarding the methods for applying revenue sharing to a plan. Back up here for a second. I think the importance of fee and service benchmarking, I'm assuming everyone on this call is well aware of the reasons why fee benchmarking and due diligence is important. There are a couple of points I would make here, though, in particular. The second bullet, the importance of having a consistent process for reviewing plan expenses is extremely important, and tied to that is the need to document the process thoroughly so that if anyone were to question whether the plan sponsor is on top of this, they can fully document it. The other point I would make is Marcia talked about the traditional pricing model, and there are still plenty of plans still using that model. Any pricing model that is based on the plan assets and the size of the plan can easily get out of balance without periodic benchmarking and monitoring. So extremely important, particularly after we've had a couple years of very strong equity markets. There are various approaches that a plan sponsor can take to conducting due diligence, and each have varying degrees of complexity and a time commitment. I have found that using a combination of these methods can not only help be an efficient approach, but also an effective way to managing a fiduciary's duties. The first one is one that I'm sure we're all familiar with, and that is the formal RFP process. Most plan sponsors do this every 3 to 7 years. I think 4 to 5 years is probably the most common process. It is one advantage to doing an RFP is that it provides very current market data regarding both price and service. One disadvantage, though, is that it can be a very time-consuming and costly process. The second approach would be pulling in data from third-party vendors. I've listed a few here. There are several others that could be used. This can be a very quick and an inexpensive way of conducting due diligence, but I would say that one disadvantage is that it provides a rear-view mirror approach to benchmarking as opposed to really understanding and reflecting current market conditions. The last approach here is what I refer to as an informal or hybrid benchmarking project, which can actually be done as frequently as every 1 to 2 years. And in this particular approach, it's not a formal RFP, and I would probably refer to it as RFI light, but it's really where we combine a variety of sources of data, everything from proprietary data that your consultant or advisor may have, pulling in third-party data, similar to the second item that I referenced, as well as a more informal market check where you go to a handful of providers and ask them for real-time pricing given the characteristics of that specific plan. When doing that, I think it's important that we try to avoid biases in the data, and by that I mean rather than just going to 4 mutual fund companies, for instance, and requesting data, we like to go to, let's say, one mutual fund company, an insurance company, bank, TPA, et cetera, so that you're getting a very broad and current market view into how providers would approach both cost and service for that plan. And really, regardless of which method is used, the results need to be well documented. You've heard that quite a bit already, and it's extremely important. I do think it's also extremely important that revenue levels be monitored on an annual basis. Clearly, as plans grow, those initial assumptions can easily get out of balance, and it's absolutely critical that those revenue levels are monitored on an ongoing basis. In addition to that, if you are using 40 Act mutual funds, it's not unusual for the revenue sharing that's being provided from the fund company directly to the record keeper will change over time, and it's critical that the plan sponsor understand what those changes are. There's a lot of data that we really try to look at when we're analyzing plan fees, and a number of different methods for analyzing fees. I've listed quite a few here, and I'm going to provide a specific example of several of these in a moment. But it's everything from looking at total plan cost to the provider's revenue as a percent of assets, revenue per participant. We want to look at transaction-based fees. Essentially any fee related to the plan we want to understand. And we want to understand those fees relative to the revenue that is required by that service provider. And we'll talk a little bit more in a moment about the various pricing models that the provider can offer. And then the next to last bullet here I think is a very important one, and that is we always need to keep in mind that the reasonableness of fees really needs to be understood relative to the services being received, and that ERISA states that our required outcome here is not the lowest cost possible, but that we're getting reasonable value for what is being paid. Now, there are certain special considerations we need to keep in mind when we're benchmarking fees and services by providers. I've listed a few here. One is the use of proprietary funds. Clearly, in the age of 4.8b2, plan sponsors or providers are providing more granular detail regarding revenue sharing. That said, there are instances where a provider may come back and say, well, if you use certain percent of our funds, we can revise our price. They don't necessarily revise the revenue sharing, but they will revise the price. It's important that a plan sponsor understand what is available and what the plan sponsor or the provider is willing to do. The next item here is on managed accounts, and many plan sponsors say, well, gee, the participant is paying for that fee, so I really shouldn't worry too much about it. But our perspective is that needs to be benchmarked just like any other service being provided by the provider. And in particular, we're seeing some providers who have had their revenue reduced over time due to competitive pressures try to make up the lost revenue by offering things like a managed account. And so again, very important that the plan sponsor understand the cost of that service and what the revenue is that the provider is generating. but also the performance and are participants actually getting a good deal for that. The next item, stable value options, and in particular general account products. As many of you may know, there is very little transparency into the actual cost and revenue of those funds, and it's important to the extent possible to pressure the insurance companies to provide some greater transparency into both cost and investment holdings. Another item is self-directed brokerage options. Again, we need to monitor and review not only the brokerage fees and commissions, but also ask the provider if they receive any revenue sharing from the brokerage accounts. Some do and some don't, and they're not always as forthcoming as we would hope in that area. Last but not least, annuities are their own unique animal. We see fewer and fewer of them in the industry, but they are still something that is seen at the smaller end of the market, and so again, very important to understand the mortality and expense and other assumptions that the insurance company is making. There are a number of factors that influence plan cost, and when determining the reasonableness of fees, it's important to know that no two plans are alike, even if the assets are the same. Providers look at a number of specific factors when they are determining what is an appropriate price, and likewise, when we're benchmarking and doing our due diligence, we need to do the same. I've listed quite a few of them here. I think some of the main ones that providers look at are things like the number of participants. In other words, how many accounts do they actually need to record keep? The average participant account balance is a very important one for many of them, particularly in an asset-based pricing model. And then last but not least, historic and projected cash flow. And that cash flow is not just a function of dollars coming in, but it's also dollars going out. So net cash flow and the degree of organic growth in the plan is an important one for most providers when they're pricing. Now, this is a very detailed chart on this next page. Let me walk you through it. I would say that many of you may have seen this if you've done due diligence or if you've seen fee transparency exhibits from providers, but essentially, and I'll use the arrow to try to point this out to you, what we have is we have a list of all of the specific funds in the plan, followed by the ticker, and in this case, the assets being held at the date that we do the analysis, followed by the expense ratio of each individual holding. And then that gives us a dollar amount of total expense paid by the plan. And historically, the historic approach to benchmarking is we add all of this up. If they're billable fees, we add that in. And that gives us a total plan cost, if you will, for the plan. And in this case, it would be 51 basis points. The steps that we're all taking now as part of our due diligence and when we're monitoring revenue sharing is we want to understand the components of revenue sharing, and they do come in different flavors, as Liz had mentioned. There are 12B1 shareholder fees, other fees, and in that area I would include things such as wrap fees, and then last but not least, sub-transfer agency fees or sub-TA fees. One of the things I'll talk about in a moment is you'll see in the sub-TA category, and actually if we look at the totals, the same is true. The level of revenue sharing varies by fund, and Marcia had pointed that out as well. That produces a real interesting question regarding if you have someone who's solely invested in self-directed brokerage, which is would be this top example, they're not paying anything toward the cost of the plan. And the folks who are in the equity funds, in the case of this particular plan, are paying 20 basis points. That does not seem like an equitable arrangement, and that is what's leading to the growth of the revenue levelization, equalization, goes by a number of names, but that's why we're headed down that path. Anyway, we followed the same process we did before, where we total all of this up. And now, in addition to having total plan cost of 51 basis points, we can see that the provider's share of this is actually 13 basis points. And then another way of looking at it is the actual cost per participant. And this is important, as we'll see in a moment, to really try to understand what the provider is getting paid. So if we look at this example, this is using the same plan, you would say that based on the analysis, we're at 51 basis points, and this is using third-party data regarding total plan cost. You would say, boy, that looks really very, very reasonable. It's not at the low, but it's very, very far from both the average and the high. And so it could lead you to a very quick decision that, yes, things are reasonable. But as we drill down further and we actually start to compare provider revenue, we can see that the story changes. That this shows it in graphical form, but down at the bottom we'll show you the actual numbers. The provider was coming in at 13 basis points, but the competitive landscape, and in this instance we went to 4 different providers, the fees ranged, or the revenue required ranged from 9 basis points to 12. So you could still argue if the plan sponsor is happy with all the services being provided, that 13 is reasonable, but it certainly does change the nature of the conversation and suggests that there may be an opportunity for negotiations. Very similar story when we look at it from a cost per participant. In addition to looking at total plan cost and the provider services, we typically exclude transaction-based fees, but we don't forget them. It's very important that we make sure that those components of cost are also very reasonable. This is just a quick example of the way that a plan sponsor could start to look at the various components of cost and then build in benchmarking data, which allows them, again, to go back to their provider and say, gee, are our fees reasonable or not? Now, I mentioned before that looking at cost is only one component of provider benchmarking and a thorough due diligence process. You also need to understand what you're getting for that. And so when a plan sponsor is preparing documentation, they need to include more than just the expense piece. And in this instance, we want to make sure that there's some summary of the services provided by that provider and whether it's working or not. In many instances, this is a summary. There would also be a detailed matrix of services that would support this. Again, there are a variety of ways to do this, but the key point is that the sponsor document and demonstrate that they're looking at not just cost, but also understanding the services provided. The next 2 pages are just more forms of communication, or documentation, and in this instance, it's just summarizing the process that was used and high-level results. I included in red here, this was an actual situation where the range of alternative provider quotes was 9 to 12, as I had mentioned before, but one provider actually said they would come in at 5 basis points if they managed 30% of the plan assets. Another came back and said they would come in at 6% if the plan moved to them and the assets initially moved to their target date fund. What's interesting is that in both instances, they weren't necessarily showing you a higher revenue sharing for their funds, but they were certainly willing to lower the price. So it's just an example of some of the things that are occurring out there in the marketplace that we need to understand and, again, document. The next page just shows you an analysis of fees and services. I think that we don't need to go through all of those details. And the next would be sample next steps, that the plan sponsor has determined what actions they want to take. In this case, it would just lead to further next steps. All of that needs to be documented to the extent that there are conversations taking place during committee meetings. That needs to be built into the committee meeting minutes. And then to the extent decisions are made, that also very much factored in. So if you include all of this reporting and documentation along with committee minutes, I think that leads us to a very thorough and well-documented due diligence process. The next, if determining whether the fees are reasonable is one step, the next step is really deciding as the plan sponsor how they want to pay for the plan and its providers. And I've seen in some instances plan sponsors actually make this the first step. They decide what they think the most appropriate payment method is and then determine reasonableness of fees. As Marcia had mentioned, some providers are willing to offer certain pricing models, others are not. And so if there is a specific model that is important, an approach that's important to a plan sponsor, and provider A can't offer it, it may very well lead them to want to go to another provider. There are a couple pieces to this that I think are important that I'll briefly touch upon. One is the various pricing models available in the market, and the other is allocation methodology. I won't spend too much time on most of these because Marcia did a terrific job covering it, but I do want to make sure that we cover a few items here. There are a number of revenue sharing arrangements, as Marcia mentioned, and revenue recapture methods. What's interesting, and I'll describe each of these models here in a moment, but what's interesting is for virtually all of these models that providers are offering, revenue recapture is often available. So it is something that regardless of which model you use, a plan sponsor could take advantage of. The bundled asset-based model is one that Marcia described quite well, and she referred to it as the traditional model. This is one where the provider assumes both the market and asset allocation risk. They also retain any surplus or deficit. Record keeping only, in this case fixed basis point, is an arrangement where the plan sponsor and the provider negotiate a formal fee as a percent of plan assets. So it could be 15 basis points, 12 basis points, you name it. That is documented, and that is what contractually the plan provider is going to receive. If the actual revenue is higher, then the plan gets a credit, and that could go into fund a revenue recapture account. One of the things that is important to note, though, is that for most of these contracts, if there is a deficit, if for some reason the revenue is not enough to cover the contractual obligation, then an invoice is sent to the plan sponsor, or those costs can be passed on to participants. So that is one thing that sponsors need to understand about these arrangements. We tend to focus on revenue recapture, but you could increase the potential for risk for the plan sponsor due to a potential deficit. Record-keeping only fixed dollar is a similar type of approach, only instead of it being asset-based or a function of the plan assets, this is more of the per capita model where it's negotiated that the provider needs $100 per participant, and it's left at that level. Again, the same form of risk applies if the plan sponsor is using fund revenue to cover that revenue, the revenue requirement of the provider. And if that revenue comes up short, the plan sponsor could find themselves owing the provider money. This was actually something that occurred back in 2007 and 2008. A number of larger plan sponsors had moved to this type of model, and then when the market corrected dramatically, they found themselves on the losing end of the model. So whether it's good or bad, we can decide, and it's not necessarily an appropriate model for everyone, but they do need to understand the pros and cons of each. One advantage to that model, of course, though, is that unlike an asset-based model, when the plan grows, the plan's assets grow, the revenue to the provider does not automatically increase as well. And then the last model, which, again, I'm not going to spend too much time talking about, Marcia did a terrific job on that, is the revenue equalization, which is certainly becoming increasingly interesting and something being considered by many plan sponsors. And this, again, is done at the participant level, and that periodic reconciliation is truly based on the specific funds that provider, that participant selects. If we find that there is surplus revenue, there are a number of methods we can take to close that gap. And again, Marcia pointed out that having lots of excess revenue is not necessarily a good thing. There are a number of actions we can take. One would be to reduce fund expenses through the use of institutionally priced investment options. Another would be to pass the revenue back to participants if your provider's contract allows that. You could use the excess revenue through a revenue recapture account to cover other plan-related expenses. And again, consider applying methods to equalize revenue. Now, the next area of debate, I think Marcia did a terrific job of setting this up. The two big questions that are being raised is really around allocation methodology, and then also what is the most prudent and equitable way to assess or allocate plan costs to participants. And so some of the questions that we see plan sponsors grappling with is, should the plan continue to pay for the plan through fund revenue, or should they go to non-revenue generating investments and cover the plan cost another way? The other is really this notion of what is the most appropriate allocation methodology, whether it's per capita or pro rata. There are pros and cons to each, which we'll talk about in a second. Illustration of the potential problem. Again, Marcia had one as well. This is really at the participant level. We can see that we have, in example one, two participants. They're each choosing, they both chose a fund that has 30 basis points from revenue sharing. Participant A has $25,000 in a balance, which equates to about $75 per year in plan cost. The other plan participant B has $100,000, which would equal $300 per year for theoretically the same services. So this shows a real disadvantage to pro rata, is that some would argue that it isn't necessarily fair for larger balance participants. The opposite is true if you use a per capita methodology, which I do not have on here, but you could have a situation where, let's say, the required revenue at the participant level is $100. That $100 is not going to feel like much of a deterrent, if you will, for the larger account balance person, but it could be a real strain for someone who has just entered the plan or has a low balance. So there are pros and cons to all these models, and one of the key is that the plan sponsor is thinking through them. And then last but not least, we have a situation which really brings us to the notion of equalization and the benefits of it. Two participants, same amount of money in the plan. One is in an actively managed equity fund, revenue sharing 35 basis points. The other is solely invested in index funds that pay zero revenue sharing. Is this an equitable way to pay for the plan? And this is not at all an uncommon approach, of course. One of the things that we'll talk about here on the next page is the potential for conflicts of interest. Again, you're the attorneys on this call, so I'll let you think through this, but there are some concerns that typically only plan fiduciaries are the ones aware of the revenue sharing at specific fund level. And if you had a situation where all of the plan's fiduciaries are invested in, let's say, company stock or brokerage account or index funds, not paying any revenue sharing, is there a conflict of interest there? So the allocation methodology is one that really requires that the plan sponsor think through the implications of all of the various options, clearly document why they've chosen a particular path, and make sure that it's the right one for the specific needs of that plan and characteristics of that plan. So just in wrapping up, the two potential solutions to this problem, we've talked quite a bit about the second one, which is revenue equalization, levelization, normalization. We hear it called many different things. The other approach that I mentioned briefly is this notion of plan sponsors moving to a period of time when they have decided, let's just do away with revenue sharing investments and go zero revenue sharing, and then we'll apply fees at the participant level, either pro rata or per capita. That's actually easier said than done, particularly if you're using 40 Act mutual funds. Many of the institutional share classes of funds out there still have some degree of revenue sharing. And so unless the plan is large enough and can go to collective trust or separate accounts, this is actually harder to pull off than you would think, which really leads us to, as Marcia said, the attraction to revenue equalization as a potential model to make sure that the revenue sharing is equal and fair across all participants and at the participant level. Now, I would say that there are some challenges to this. First of all, it's administratively complex. The vast majority of providers that we've seen can handle this, particularly if the plan is large enough. but we are finding it at the smaller end of the market a little more difficult to come by. And providers are in different stages of actually developing the solution. The other thing is it does add a level of complexity for the participant, and so the sponsor needs to think through clearly how to communicate this to participants so they'll understand it and hopefully value the more equitable approach. Let's see, that's really where I will leave it. The fee disclosure has not resolved everything. Plan sponsors need to continue to pay attention to fees, and they really need to start to think through what the various pricing options are that they have and what's the right allocation methodology for their specific plan. So with that, I'll now turn it back over to June, our Strafford moderator.
Great. Thank you, Elizabeth, Larry, and Marcia, for your insights today. Before we start our live and interactive question and answer session, a brief announcement. Many states require that you record and report the following code in order to obtain CLE credits for the live or recorded version of this CLE webinar. If you will be requesting CLE credits for this seminar, please write this code down on your attendance form. The code is TLAJEA. That's T as in Tango, L as in Lima, A as in Alpha, J as in Juliet, E as in Echo, A as in Alpha. Again, that's TLAJEA. You will receive an email with a link to the CLE form at the conclusion of the program. Now on to our live question and answer session. Listeners can ask our speakers any questions relevant to today's topic. First, you may email questions to erisalaw@straffordpub.com, or you may submit your questions by typing your question into the Q&A box at the bottom of the screen and hitting enter. You may also ask questions by telephone. To do so, simply press *1 on your touch-tone phone. Again, that's *1. After you press *1 and when it's your turn, you will hear that your microphone has been turned on and you have the floor. If for any reason you decide not to ask your question, you can press *2 to exit the question queue. If you are asking a question by telephone, please turn off the sound to your desktop. So our first question reads, does the term revenue sharing encompass mutual fund finder fees and 12B-1 fees? And are such fees governed or related to the 2013 DOL advisory opinion on revenue sharing?
So this is Elizabeth Dyer, and I can field this question. So the term revenue sharing picks up a wide range of payments and would generally pick up 12B1 fees and certain finder's fees. And when determining whether or not revenue sharing payments would constitute plan assets, the Department of Labor advisory opinion would be the place to look for the guidance. So you take into consideration the underlying agreement and the intent and actions of the parties, and then kind of apply all of those principles that we described at the beginning to the arrangement, and that would help you get to an answer of whether those payments constituted plan assets.
Great, thank you. So our next question reads, investment advisory gives any bank referral source a percentage of its fee, for example, 15%, on an ongoing basis. If this fee is disclosed under 408B2, is there any problem with this arrangement?
Basically, it's a referral fee, and it's got to be reasonable. And what services are they rendering for it? This is pre-facts and circumstances. 15% might seem somewhat high, quite frankly. I need to know a little bit more in order to opine. But one would think that certain services need to be proffered, and mere disclosure does not obviate the potentiality of a prohibited transaction.
All right, thank you. So our next question reads, are service providers required to disclose exactly how the amount deposited in the ERISA account are calculated? Some providers state that the determination of the amount paid is, quote, proprietary.
Well, yeah, I think they do have to determine how the amount is calculated. Maybe you don't have to go into excruciating detail to the, thousandth basis point, but in order to determine what is the recapture amount, there needs to be something that is relatively formulaic that a plan sponsor or other fiduciary can look at to make sure that the appropriate amount is, in fact, being contributed to the plan account.
Right. I would just add that in addition to that, my experience has been a number of providers calculate at different frequencies, and so that's something that when you're looking at their service agreements and contracts, you really need to pay close attention to exactly how frequently they're going to do it and what the formula is.
Okay, so we have a live question now from our audience, so we'll go to our live question next.
We have a question from Emily.
Yes, in determining whether to use the ERISA account or the bookkeeping account, if you've gone through an RFP and determined that a reasonable fee would be, let's say, $10,000, for example, for record-keeping services, but you understand that you will net significantly more than that, or that the vendor will net significantly more than that, since the vendor's overall compensation will be significantly more, do you have to use the ERISA account? I guess my theory would be, if you don't have a contractual arrangement or requirement for them to put the excess back in the plan, how would you show that your comp arrangement is reasonable?
By reconciliation. That's how you would do it. In other words, I think it's frankly almost a matter of indifference. And I can't say legally whether ERISA recapture is better than a normal bookkeeping account. I really can't. That's frankly something for ERISA counsel in conjunction with plan sponsors to determine. What I can say is that a bookkeeping type of arrangement can have the same terms and conditions effectively as an ERISA recapture account, and the amount of money and the frequency by which this is going to be transferred, or what the vendor's net, even gross, is going to be, shouldn't really affect what you do in one way or the other. It really is what the plan sponsor wants. Now, having stated that, I think it's clear to track money once it's put in a plan account, a real ERISA recapture account. But oftentimes plan sponsors don't want to deal with a plan asset issue, and they want to be able to allocate that money to participants' accounts as employer contributions, et cetera. These things are limited if money is in an ERISA recapture account, and the 408B2 disclosure is somewhat more complicated as well. So there's a countervailing facts and circumstances determination that must be done in cases like that. But I can't say that one would be better than the other. It really is something where ERISA counsel needs to get involved.
I would also again say that if there's that big a variance between what the provider requiring and what's actually being generated, is the sponsor really needs to start looking for lower cost, lower rev share investment options. There are other ways to get that, to close that gap.
Thank you.
All right, so our next question reads, is there a material difference between the amount of revenue sharing received by a vendor with respect to a plan and the, quote, estimated amount of revenue sharing they agree to credit or pay to the plan? If so, should the plan committee review the details of the vendor's estimation methodology?
Well, there shouldn't be a very significant gap. If there's a significant gap, then common sense would dictate that a reasonable person would try to determine why, and that is what a fiduciary has to do. They have to behave as a prudent expert would.
Okay, so our next question reads, if negotiated fee is $7,500 and revenue sharing will net $1,200, can you use the non-ERISA bookkeeping account, or is there a fiduciary concern of excess compensation so that the funds have to go back to the plan?
Again, I believe the prior caller asked something substantially equivalent. It really is a matter of indifference legally as to whether the money is going to go, that excess, that delta, that surplus, is going to go into an ERISA recapture account, i.e. a plan asset, or into a bookkeeping account. However, what is not in question at all is that that money has got to be used to benefit the plan and its administration, its non-lower capacities, participants, beneficiaries, and alternate payees. That is the issue. Now, if that type of money year in and year out is going to be going into a bookkeeping account, the contract must be clear. And actually, even the plan document terms vis-a-vis an ERISA recapture account need to be clear. Following on what Larry said, if there's going to be a significant delta like this year in and year out, perhaps alternative investment classes, investment options need to be explored.
All right, thank you. So our next question reads, must a contractual right, which is a plan asset, be held in trust, valued, and reported on a Schedule C of the 500?
That's an interesting question. In other words, if pursuant to the principal case, is the right to receive revenue share itself something of tangible value, and should a present value calc be done to determine its worth? Interesting. I would say no, but really interesting question. We'll see where the law leads. Pretty cool question, though. Whoever asked that, that's a very neat question.
All right, so our next question reads, does it make a difference if you wanted to pay insurance for plan fiduciaries out of a bookkeeping account versus an ERISA account? That is, ERISA 410A issue for ERISA account, but not bookkeeping.
Oh, my God, these are good questions. You cannot use plan assets to buy fiduciary, well, I guess you could, but then there'd be, if payments are made, they'd be exempted. For all practicality, you really cannot use plan assets to buy fiduciary liability insurance. And given that, as we just discussed, the right to receive revenue in bookkeeping account is a plan asset, I would say either under an ERISA bookkeeping account or a recapture account, one cannot and should not use such money to buy fiduciary liability insurance. Excellent question, though.
Okay, so we have another live question. So, Claudia, please introduce our live caller.
Our next question will come from Laura.
Hello.
Hi.
This is John. My question for the bookkeeping alternative and the contractual right that was mentioned just a short while ago, could you elaborate on the contractual right? It seems that if there's any contractual right, then that becomes a plan asset, and it seems to take you out of the bookkeeping alternative.
Excellent question. I believe the contractual right itself is a plan asset. Absolutely. It's just the money is not in a trust. It's not in a custodial arrangement. Now, you might say, well, is that a difference that makes a difference? The answer is absolutely it's a difference that makes a difference. What is the practical effect of it? I mean, a lot of it is the 408B2 disclosure. A lot of it's how it's disclosed on the 5500. And also, I think that a very significant thing is that I think there's a 406B issue with using money in an ERISA recapture account to pay an employer-mandated contribution whereas there isn't in the bookkeeping account type of arrangement. And I would just follow on the principal case for that. But you raise a really good point, John. What is a substantive difference? I just gave you 3 or 4 issues, but are they significant? For many plan sponsors, maybe not. But for some, and for those that matter, it is, which is why ERISA counsel needs to be involved.
So does that mean then at the end of the year, if there's an excess amount, then the service provider would contribute whatever that excess is to the plan to be allocated as earnings?
That is what I'm saying. But, I mean, again, you're going to have to draft it that way. Or what I've seen some contracts do is that especially on termination, but even after a certain period of time, that amount reverts back to one of the vendors. That's why contracts are, with the bookkeeping account, the contract itself is important. Because what happens to reversion? What happens at the end of the plan year? Where does it go? Okay, whereas, compare and contrast, there's no question whatsoever within a ERISA recapture account. Those are plan assets. They must be allocated or utilized for the benefit of the plan participants and beneficiaries.
Okay, that's helpful. What we're grappling with is this whole scope of the contractual right.
Yeah, I know.
Does that mean that you put in a completely discretionary provision on a part of the service provider, wherein the service provider has the sole discretion to pay any submitted expenses from the bookkeeping account?
Well, what I would do, and this is more an art than a science, John, but what I would do is I would have I wouldn't have unfettered discretion. I would say the service provider, once it informs the employer, and if the employer doesn't say no within a certain period of time, has effectively unfettered discretion for the utilization of non-settler expenses from the bookkeeping account. However, it should also be very clear what happens with assets that are there at the end of the year, that they're allocated on a pro-rata basis or what have you, and it must be extremely clear that if there's going to be a contract termination, the assets flow to the plan and do not stay with the record keeper, the bookkeeper, what have you. That is what I would do. That is what I would draft. That is what I have drafted.
Okay, thank you.
You're more than welcome.
All right, so our next question reads, what expenses, if any, should always be allocated on a per capita basis?
A per capita basis? I don't really understand the question, but for example, if someone has a quadro, one would think that they would pay for that themselves. If someone has a loan, they'd pay for that themselves. If someone has ownership, they'd pay for that themselves. Is that the question? If that's the question, that's the answer.
That's what I was going to say as well. I think some of these participant transaction-oriented expenses, it makes a great deal of sense to do it that way. For other plan expenses, it really is situational and requires that the plan sponsor think through the pros and cons of both per capita and pro rata.
All right, so our next question reads, can the refund or recovery arrangement between the record keeper and the investment manager affect whether the recapture to the plan sponsor is a plan asset?
I don't even understand the question. I'm sorry. If money is coming from a plan asset, from plan, and flows to a record keeper, then yes. If it's coming from the general account, like almost as a founder's fee, then no. It really depends on the origin of the cash.
All right, thank you. So we'll take one more question since we're running out of time. So our last question for today reads, if you have a contractual right and the bookkeeping account becomes a plan asset, are you required to hold the account in trust?
The answer is no.
All right, short and sweet. Thank you. So again, I'd like to thank all of our speakers, and we hope that everyone has enjoyed our national webinar, ERISA Revenue Sharing Arrangements, Avoiding Plan Asset Status, Complying with Due Diligence Requirements, Best Practices for Utilization of Excess Payments, Negotiation of the Contract, Allocation of Credits to Plan Participants, and more. If you have a question that was not answered, you may email it directly to our presenters. Their email addresses are included in the presentation materials. An evaluation form will be emailed to attendees shortly. Please take a moment to fill out and submit the form to let us know how we did today. Listeners who have ordered or wish to order CLE credits must verify their participation in today's conference by submitting the completed attendance register that is part of the conference materials. You will receive an email with a link to the CLE form at the conclusion of the program. It's also available on the program page at the top right-hand corner. We will issue verification of CLE credits as they are granted by the states that accredit webinar events. If you have any questions about CLE credits for this webinar, please call our CLE service at 404-881-1141, extension 35. Today's participants can order a recorded version of this event at a special attendee price. Please call customer service at 800-926-7926, extension 10, or visit Strafford's website at www.straffordpub.com. Please be sure to check Strafford's website for information on future Strafford CLE programs, including a seminar on defending ERISA conflict of interest discovery requests, limiting the scope of discovery, preparing and defending 30 B6 depositions, and more on Thursday, March 27th, 2014, starting at 1 p.m. Eastern for 90 minutes. Strafford would like to thank you for your attendance. To end this call, simply hang up the phone. Thank you and have a great day.